Hi, Martin Turner here. This week we look at double entry accounting, and this will be the first of 3 weeks where we're looking at this topic. Today we'll be recapping last week, and then we'll look at 3 things to memorise. These are things, yes, you need to memorise. This is the key to getting a hold of your bookkeeping and double entry accounting. We'll then look at ledgers, which in many ways is the heart of the accounting system. And then we'll look at GST and see that GST comes up into a lot of transactions in accounting, and that's why we're looking at it early on. Then we'll look at journals, where we record transactions each day or as they come in. And then we'll look at a minute paper and then a summary. Recapping last week. Last week we looked at the proprietorship concept. This is the concept that accounting looks at the firm as being separate to its owners. And it's this view of business that leads to us having double entry accounting, where everything a firm does affects itself, asset and liabilities, and its owners, equity. We also looked at accrual accounting, and we saw that accrual accounting is where we record in the accounts transactions and economic events when their economic substance occurs, which may be at a different time to when cash changes hands. We looked at the fundamental accounting equation, and that's assets plus expenses equals equity plus revenue plus liabilities. And we saw the 5 elements of accounting and their definitions, and we reviewed those from Act 11059 and strengthened them and deepened them a little bit. And in particular, we looked at the difference between revenue and income, which in broad terms is other comprehensive income. The 3 things to memorise. These is the 3 things you need to know to do bookkeeping or double entry accounting. 1, an increase in asset is a debit. 2, assets plus expenses equals equity plus revenue plus liabilities. And 3, increases on the left-hand side, asset and expenses, are debits, and increases on the right-hand side, equity, revenue, and liabilities, are credits. Have a look at the study guide, chapter 1, section 1.4. Take time out, you could do it right now, turn off the video. Take time out just to write down these 3 things to memorise a few times, and grab hold of this, and this will help you right through your study of accounting. Now the next thing we'll look at are ledgers. These are all the accounts for assets, liabilities, equity, revenue and expenses. And they're very much at the core of the accounting system. So there are ledgers and then there are subsidiary ledgers. And because there's some accounts in the general ledger where a firm might want to record further detail. Some common examples are accounts receivable, accounts payable, plant and equipment, and other types of non-current assets, and inventory. Now, a key thing to remember about subsidiary ledgers is that they are supplementary accounts. They're additional detail to support the balance in a control account. So we might have accounts receivable, which is the amount that our customers are owing us, but we might want to know all the details for each customer so that we can chase them up and keep track of them. And so we might have a accounts receivable control account in the general ledger and individual customers' accounts receivable in the subsidiary ledger. Now, one of the benefits of doing this is that it can help in our internal control, because we can give different people read-write access to, say, the accounts receivable control account in the general ledger, and a different person to the individual customers' accounts receivable accounts in the subsidiary ledger. This can give a degree of internal control because one person can't just manipulate the accounts receivable accounts on their own. They'd need to do it in collaboration with another person, which can make it much more difficult. So how might having these subsidiary ledgers help support internal control? Well, for all those accounts, like accounts receivable, accounts payable, could be inventory, can be various non-current assets, plant and equipment and so on. By separating out the general ledger and the subsidiary ledger and have different people recording in them and having access to them, this can reduce the opportunities for one individual to cause trouble in the accounts. So that's introduction to the ledgers. In GST, Goods and Services Tax, that's in Australia and New Zealand. It's known by other names, particularly Value-Added Tax, VAT, in the UK. And we're looking at GST now because GST comes up in a lot of transactions in business. Particularly with revenue expenses, it's pretty well in all the transactions. Now, GST in Australia is 10%. And GST items in our accounts and transactions, they can either be GST exclusive, which means the amount doesn't include GST, or they can be GST inclusive, which means the amount does include GST. Let's have a look now at a video on GST.
Are you struggling to understand how firms account for GST? This video will give you some tips to help you when accounting for GST comes up. GST comes up in a lot of different transactions for a firm, so we need to understand the basics of how to account for GST right at the beginning of our study of accounting. The first tip is that typically all items in a firm's income statement are exclusive of GST. This means that when Coles sells you a chicken for $8, it will only include $7.27 as revenue. The rest, 73 cents, is the GST Coles has collected from you for the government. This amount is kept in a separate account, GST Collected. Revenue accounts are usually shown exclusive of GST because the GST a firm collects from its customers is not its own revenue. Rather, it is money the firm collects for the government. The same also applies to a firm's expenses. Coles may have bought that chicken for $6.50. It would only include $5.91 as an expense in its accounts. The rest, 59 cents, is the GST Coles has paid to its suppliers and which it can claim back from the government. This amount is kept in a GST paid account. By keeping the GST collected in its own account separate to its revenue, a firm can carefully identify GST and manage it separately to the firm's revenue. The same applies to its expenses. The same also typically applies to all items in a firm's balance sheet. These are usually stated exclusive of GST. A key exception to this is accounts receivable and accounts payable. These items in the balance sheet are usually shown inclusive of GST. This means that unlike most items in the balance sheet, accounts receivable and accounts payable do include GST. This is because our customers owe us the GST inclusive amount, not just the part that is our revenue. And we owe our suppliers the GST inclusive amount, not just that part that is our expense. When we chase up our accounts receivable, customers who owe us money, we need to collect from them the full GST inclusive amount. And our suppliers expect us to pay them the full GST inclusive amount as well. Firms often handle GST in three separate accounts: GST Collected, GST Paid, and GST Payments Refunds. As there are no standard terms in accounting, these accounts can have a range of different names in practice. You will have lots of opportunities in our unit and throughout your degree to practice how we account for GST. You will see GST comes up a lot in accounting. Further key details about how we account for GST are in Chapter 4, Section 4.1 and Chapter 2, Section 2.2 in our study guide. To find out more about how GST works in Australia, go to the link in the description below this video.
So, GST. In the income statement, revenue and expenses accounts usually exclude GST. And in the balance sheet, assets, liabilities and equity accounts usually exclude GST as well. A key exception of this is accounts receivable and accounts payable, which typically include GST. Also, the cash flow statement, items in that statement usually include GST. So if you keep this in mind, you know what you're looking at when you're looking at each of those financial statements. We also saw in the video that firms keep separate accounts for GST. A GST collected account, that's where items are credited, which is a liability. So it's a liability because this is the GST that's been collected from the firm's customers, which it then needs to pay on to the government. And GST paid account, items in there go in as a debit. It's an asset. Increase in asset is a debit. And that's where we're paid GST to our suppliers, and we can claim that back from the government. We also saw that firms can also often have a third account, which is GST Payments Refunds account, which keeps track of those additional, keeps track of the payments and refunds that are going to and from the government. Sometimes firms just include it in two accounts, the first two accounts. So GST collected on behalf of the government, GST collected account a liability, GST paid is it's paid to its suppliers. That's where the firm's not the final customer for that item. That's where you can get a refund back from the government. So we've seen that GST affects all the accounts of a firm potentially. And the key things to remember are revenue and expenses typically exclude GST. GST is handled separately in special GST accounts, and the cash flows between a firm and the government regarding GST are carefully identified in these separate accounts. So that's a little introduction to GST. We'll now have a look at journals. Journals are the daily or moment-by-moment record of a firm's activities. And journals, there can also be specialised journals, for example with sales and purchases, which provide a lot of extra detail. So with specialised journals, say with sales and purchases, they can be journals such as sales on credit would go into a sales journal, and sales for cash would go in a cash receipts journal. And the general journals are where transactions don't fit into one of its specialised journals. For example, items such as bad debts written off, credit purchase returns, credit sales returns. And the specialised journals, there's a key difference between specialised journals and the subsidiary ledgers we saw before. When we looked at subsidiary ledgers, such as, say, with accounts receivable, that they were in addition to the general journal. so they provided supplementary information in more detail. With specialised journals, the only journal entries are in the specialised journals. There are no general journal entries for those items. So specialised journals replace any journal entries, whereas that's the specialised journals where the subsidiary ledgers don't replace the control account in the general ledger. All right, take a minute now to answer these two questions. What was the most important thing you learned today, and what questions still remain unanswered? Take a minute now to answer those two questions. Well, welcome back. To do that minute paper, ask yourself those two questions after any class you do, or any video or material you're reading, can be a very valuable trick or valuable tool to help you to strengthen your learning. And so well worth taking that minute. So what have we looked at today? Well, we recapped last week. Last week we looked at the proprietorship concept, the idea that a firm is separate to its owners, and that everything a firm does affects both its owners, assets and liabilities, and both the firm, assets and liabilities, and its owners, equity. And that's the basis of why we have double entry accounting. We also looked at last week at accrual accounting. This is a key concept in accounting which you need to get a grip on and really reflect on getting a good, tight understanding of it. Accrual accounting is where we record transactions or economic events in our accounts when their economic substance occurs, which can be at a different time when cash changes hands. And yes, there are judgments involved in determining when the economic substance occurs of transactions. Quite often that can be the case. We also looked at the fundamental accounting equation. You need to know that. That's one of the three things to memorize that we looked at today. You need to know the fundamental accounting equation. Assets plus expenses equals equity plus revenue plus liabilities. We also looked last week at the definition of the 5 elements of accounting, and we reviewed what we'd done previously in Act 11059 and developed those definitions a little bit further. And in particular, we looked at the difference between revenue and income, and which is primarily other comprehensive income. So this week we looked at 3 things to memorize. If you haven't done it already, you should turn off the video now and write them down a few times. If you write these 3 things to memorize down 40 times, perhaps 8 times a day over 5 days, or 40 times right now, if you write them down 40 times and then just occasionally review, come across them and review them, which is something you'll do in accounting, you will know these things for life, and they'll give you a foundation for being able to understand the bookkeeping that we'll be looking at. The 3 things to memorize: increase in an asset is a debit. Also, the fundamental accounting equation, assets plus expenses equals equity plus revenue plus liabilities. And the 3rd thing to memorize is increases on the left-hand side are debits. That's increases in assets and expenses are debits. And increases on the right-hand side, that's equity, revenue and liabilities, are credits. The 3 things to memorize. That's the trick to get on top of your bookkeeping and double entry accounting. We then looked at ledgers. These are at the centre of our firm's accounts, and that's where the assets and liabilities and equity and revenue expenses accounts are. And we had a look at subsidiary ledgers, which give further detail. We'll be looking into all of these things in greater detail next week. We also had a look at GST, Goods and Services Tax, which is 10% in Australia, and we saw that GST comes up in a lot of transactions, and that's why we're looking at it up front. And we saw that generally in the income statement, items are exclusive of GST, revenue expenses, and in the balance sheet, items are also generally exclusive of GST, assets, liabilities and equity. Two common exceptions to that are accounts receivable and accounts payable, which are usually inclusive of GST. And we also saw in the cash flow statement that items in the cash flow statement are usually inclusive of GST. We then had a look at journals, which is the day-to-day, moment-by-moment recording of transactions and economic events as they occur each day. And we had a look at how we can have specialised journals where we put certain transactions, such as our cash journal or our credit sales journal for credit sales. A cash journal might be for cash sales, and where we group these like transactions. Again, we'll be looking at more of this next week. And we saw how the subsidiary ledgers just provide extra information to what's in the general ledger, but the specialised journals, they stand on their own. There are no general journal entries relating to what's in the specialised journal. We then did the minute paper, and we've had this summary. Well, thanks very much. It's good to be starting this topic of double entry accounting, and bye for now.